I emphasised. And as we set out in the box, we are looking, as we always do, we're monitoring market functioning. But, to just finish, the process is that we put out our analysis now, and then we make a decision on what will be, if you like, the total reduction in the stock of asset purchases for the next QT year, which will run from October to next September. That decision will be made in September. So we've set the scene with the box today. Quite a lot of detail, quite a lot of new analysis in there, and then the decision will be made in September.
As we always do.
Maurizio and Tim.
Hi there, Maurizio Allen-Carr from City AM. The monetary policy report says the government's fiscal policy is dampening growth. So would a decision to raise taxes further in the autumn, as is widely expected in the city, risk sending the UK economy into a doom loop and even further dampen growth? And just to add, the banks obviously had accusations of groupthink in the past. Is this sort of unprecedented vote today, or double vote, what does that say about the MPC as it is right now?
Sure. So two very different questions, so I'll take them completely separately. So obviously, as you know, we condition our view forward on announced fiscal policy. Obviously, the announced fiscal policy that we are conditioning on at the moment is essentially the budget and the spring statement. That's where we are. And I'm not going to speculate on whatever the government may or may not do in the period to come. That is obviously for the government. We will obviously take it into account when it's announced and not before. So that's a very, very standard operating procedure and rule that we have, and that's how we will do it. Turning to the vote, you're right. I mean, this is the first time that we had two votes. Just to be very clear on this, because it's set out in the minutes I think, very clearly. The distribution was 4 members. In the first vote, the distribution was 4 members preferring to hold at 4.25, 4 members preferring a 25 basis point cut, and 1 member preferring a cut of 50 basis points. Now, I'll just explain. So, obviously, there is a provision in the legislation for a casting vote. My view on that, and view I said very clearly to the committee, is that I think that provision, and it has been used at least once, is a provision that is there when the committee, for whatever reason, doesn't have 9 members. It has an even number of members. And so it is possible in that situation, of course, to have a tie. That's not the case here. I mean, it's clear that with that distribution of votes, that the balance of the distribution was to cut rather than to hold. And so I thought it was appropriate, therefore, that we had a second vote. And we discussed this, by the way. We had a second vote, which, of course, was a constrained vote in that sense, and saying to the committee, look, we can see where the balance is, we can see where the distribution is. So I think it's appropriate now to have a second vote, because it's critical that, obviously, we reach a decision. We're here to reach decisions and to implement them. But from that, I think it's clear that the sensible second vote is to choose between the two, obviously, most, in a sense, popular in the first round outcomes, to hold or to cut by 25. That's what we did, and that's where you got the clear outcome of the second vote. Now, I think that's a sensible interpretation of the legislation and the MPC's procedures. But what I want to emphasise is that even though we had 2 votes, just to emphasise, what really matters is the decision and the outcome, and that's clear.
Go ahead, Tim, and then Delphine.
Thank you. Tim Wallace of the Daily Telegraph. We've heard quite a lot about the impact of the national insurance increase, the living wage changes. What's your assessment so far of the impact of the Employment Rights Bill on businesses, on workers, on inflation, and so on the path of monetary policy?
Happy to. I mean, very little, because we don't know the detail of it, and businesses don't, and so we haven't got an impact of it. It doesn't feature in our forecast. We will obviously, as we find out once confirmed, we will talk to and use our agency network to find out how businesses are responding to it. But until we know what it is, we can't in fact.
It really hasn't featured in our discussions.
Delphine and
Thanks. So, as you set out in the report, the UK seems to be looking both at a bigger near-term rise in inflation than other countries, partly due to the tax increases from April that are still feeding through, but also a longer-lasting period of high inflation, which has obviously been a feature for quite some time. What is it you think is unusual about the UK? Is it something about fiscal policy? Is it something about the labour market? Or is it that inflation expectations have drifted?
Well, I was Claire wants to come in. I think, Delphine, you have to look at both the sort of what I might call the demand side and the supply side here. Because, one of the important questions, obviously, is the sort of the constraints coming from the supply side, and particularly in the labour market. So we have seen a fall in participation over the last, since COVID, really, actually, in terms of labour market participation. Now, of course, there's all sorts of uncertainty around this, given the issues with the LFS. So we have to look carefully at all of this. And unfortunately, participation is one area where we're almost solely dependent on the LFS. It's the one area where you can't easily substitute with other things. But we have seen that tightening. We do also describe in the report, and Claire may want to talk about we've changed, not because we've taken a judgment, it's just that the ONS has come out with new profiles. We've changed the population profile as well. So that's a backdrop to it, really, in terms of the labour market, I would say.
Yeah, I mean, I would supplement that. It's very hard to judge the level of supply in the economy. And that is clearly part of what is going on here. As Andrew said, there's a set of questions about the labour market, particularly around participation and what structural changes we may have seen, as well as what's going on cyclically there. We have in this report actually taken on the updated figures from the ONS about population. So they've estimated a lower working age population. We've taken on that in this report. So that reduces the labour force by, I think it's 0.7%. In terms of the level at the end of the forecast, that has an impact as well through this. But I mean, it's not a huge change, but it's in there. So, in understanding what's going on with the UK, you do have to think about these questions about both supply and demand, and it's not a totally straightforward picture.
It's quite complicated because you look at it, the back data has been revised, and the forward-looking profile has been revised as well. So it's quite complicated to parse these things out.
But I think the question is a really important one. I mean, from my perspective, just over a year ago, I was thinking that in inflation terms, we look more like a laggard than an outlier. But the nature of the persistence of inflation, it surprised me, and I think it has. It does lead you into these questions that Andrew and Claire, that we're all grappling with. How much is there a difference in terms of the UK's supply side, the way we've responded to a set of global shocks, and how particularly that manifestation of both increased persistence compared to what our conventional models would suggest. We have this suite of wage models, and wages have stayed above the swathe that you'd get from that suite of models. What does that tell you about changes in the wage setting, but also the price setting behaviour? And it does tend to come back to these kind of supply side factors, because most of the demand factors will be common across economies, whereas for us, it's more, we've been hit by the shocks, and then how has the economy responded to those? So I think it is we clearly see that that's a kind of, it's not just a challenge for monetary policy makers. It obviously is a particular challenge for us because our job is to get inflation back to target. But I think it is also something the OBR are grappling with, Something that understandably the government is grappling with when it's, with its growth agenda, because it wants to move out of this period of very subdued growth, very subdued supply side growth, which, if you like, is the speed limit on the UK economy at the moment.
I would though just say, just remind against this sort of point which we've all said, which is genuine questions around sort of the structural side of the labour supply story. Just to remind, obviously, this, as I said earlier, if I had to sort of pick out a piece of news in the data since May, it's that pay has come in lower than we thought it would be. So this is a tension.
Philip and Dave.
Hi, Philip Inman from The Guardian. Given everything you've just said, Dave, would it not be the case that the British public would be rather confused that you're cutting rates today with the persistence of inflation that you've just outlined, regardless of all the underlying cross-currents that you also described? Surely they would be expecting you to hold rates today. They want you to tackle inflation. And aren't you going to just collectively encourage wage rises now? Aren't those workers now going to think, well, we've got inflation going through to next year, it's not going to be below 3% next year, we need to go and get higher wages, not lower?
I'm sure others will want to come in, but if I can start, I think it's really, I take you back to a kind of couple of things that Andrew said in his opening remarks. One is that the underlying disinflation process is continuing. We've been talking about this persistence in inflation for the best part of a couple of years. Our judgments on that persistence haven't changed, but that persistence, certainly compared to my expectations 18 months ago, it has continued to manifest itself. But we are still seeing the underlying disinflation process continue. Andrew's just talked about wages actually coming in slightly below our expectations. He also had a chart that showed services inflation once you strip out administered prices, still on a declining trend. The other thing to bear in mind is that we've reduced bank rate today, but we think that policy is still restrictive, and that's about past policy. We only started cutting rates a year ago. Before that, we had policy at 5.25% for a year. So policy remains restrictive, both in terms of past tightness of policy feeding through, and also when you take account of what's priced into the yield curve in the sense of bank rate is now at 4%. It's not like if you look at where official rates are in the euro area, they're much, much lower. So it's a question about how you. What I was trying to talk about is a kind of ongoing puzzle, but you then have to put that in the context of how we've been grappling with those challenging issues in the economy over the last couple of years.
Dave.
Thank you, David Robbins from Market News. Just a quick question on Bernanke and the progress, or lack of it. In May, we had at least some illustrative 2 scenarios with illustrations. You've got a reference to the upside one again here, and you do reference it. But we haven't come up with another alternative downside scenario, if I understand it rightly. I mean, that one had trade uncertainty in there. You seem to de-emphasize that. And there was also a hot debate last time about whether alternative scenarios need alternative rate paths. Are these still subjects of internal debate? Do you actually know where you're going on this? And is it just a case of taking time to get there, or is it still all up in the air? Thank you.
So look, thanks for the question. I mean, we're continuing to progress the work on implementing our changes in response to Bernanke. We did, as you say, we had 2 scenarios in May. We used them again this time round in our policy discussions, in our debates, and as we've said, the upside scenario for that time, which was a higher inflation persistence scenario, felt pretty relevant and actually was an important part of the discussion in helping us sort of tease out what could that look like and what would the implications be. So we've done that. I mean, we also continue to do lots of other things that are going on in the background and actually are a really critical part of delivering this. So, could talk for hours about delivering major IT reforms, but we are building a new data platform that we are implementing from the middle of next year. We hope to be moving some of the big parts of our infrastructure onto it, the forecast, the scenarios, that will allow us to do an awful lot of more nimble analysis, automate more analysis, those sorts of things. Now, it's not exciting press conference type stuff. It's really important, but it's pretty methodical work to change IT systems, for example. So, all of that is going on in the background. We've also done a lot of some other things that you will have seen publicly, publishing some more papers, like research papers on our models. For example, we've had a couple of conferences, those sorts of things. So, the work is ongoing on it. We said it was going to take some time, and we are thinking actively about actually how we should change our comms as well as part of that. So, it's ongoing. We never said it would be super quick. We are, the scenarios we have built, we are using, and they are changing the way in which, you won't see it, but the policy debate and discussion is one that, now has a much richer and more varied series of inputs going into it, and much more discussion of differences in policy across the committee, which, as you can see from the vote, there are lots of differences of views about many of the things that you've raised in this press conference and beyond, and on those sorts of things, having a wider range of inputs that allows us to explore some of these in a bit more detail is proving useful, but we're learning as we go.
Ryan.
Thank you. Ryan Savey from The Sun. The government regularly talks about driving up living standards, but with low growth and productivity issues sort of more widely. Do you feel like they're on track, or what has actually led you to see that living standards may rise?
Well, I said before, I strongly support, by the way, both this government and previous government actually, for the emphasis on growth and on productivity. I think it's critically important for all sorts of reasons. Actually, it's important for monetary policy, but it goes obviously much beyond that. And I think your question was sort of phrased in those terms, and you're right in that respect. So I strongly support that. I think the government's got a number of reform proposals in its policy agenda there, which I think are all very sensible things. And I would just strongly say that we need to be very focused on reforms and changes that will raise the potential growth rate of the economy, and that is really about raising productivity growth. This is critical because, I've said it before, I'll say it again, if you look over history, what moves the dial on growth tends to be big shifts in productivity growth, which don't happen frequently because they usually require some form of sort of quite big breakthrough on sort of technology and so on. But obviously capturing that and making sure it's implemented in the economy and therefore benefits living standards is absolutely critical. So I strongly support the government, as I say, as I did the previous government, actually. I think this is not a political point at all. It's critically important.
Last question, Subhan.
Thank you. Subhan Abdullah from Reuters. Governor, do you think that the Low Pay Commission's new recommendation for a 4.1% pay rise in a minimum wage in 2026 will make it harder to get inflation back to target?
Well, we always say we take into account announced policies. So, by the way, that's obviously not an announced policy yet. I mean, the process is ongoing and underway. And we will take it into account when it comes out. I don't think it's appropriate for us to offer any judgment on what that should be, because frankly it's a public policy decision which takes on board many things, many aspects. I will of course say that I think it's important that the inflation price stability actually and the benefits of that for the cost of living feature in the set of issues that are taken into account in considering that judgment. But that's as far as I will go, because I think that's as far as it's appropriate for the Bank of England to go in that respect, to just remind that price stability is important. But there are many other considerations. I fully recognise that.
Thanks very much, everyone.
Thank you, and have good holidays if you're about to go on holiday.
So Bank of England officials there speaking following the central bank's rate decision. A hawkish cut the market makes of it. We had a cut by 25 basis points to 4% as anticipated, but the real drama coming from that vote split. Initially, you had Claire Lombardelli, Catherine Mann, Hugh Pill and Megan Green voting for a hold and Alan Taylor joining them. But Alan Taylor then switching his vote, having voted initially for a half-point cut, then to a quarter-point cut to get that majority through. So this is a historic vote. It was the first recast vote in the Bank of England panel's 28-year history. Elsewhere in this decision, we had the guidance kept as the path ahead being gradual and careful. And you just heard there in the press conference the governor emphasising that inflation won't persist, but that these second-round effects are very much in focus because of the centrality of food price inflation to this inflation spike and the impact of that, of course, on consumers. Let's just take a listen to what he had to say on that.
We think that inflation will increase to around 4% in September. Our job is to ensure that inflation falls back to the 2% target once these temporary factors pass, as we expect to see. So it remains important that we do not cut bank rate too quickly or by too much.
So very much emphasising how finely balanced this decision was, but saying that the path for rates is downwards. Looking at the market reaction, we have the pound trading higher against the dollar, up 0.5% at $1.34. Not far off, it has to be said, where we were before this decision. But you've got the two-year gilt yield up 5 basis points at 3.87, and you're looking at the FTSE 100. The FTSE 250 flat as a pancake off the back of this. But, of course, we have seen a lot of optimism in these equity markets today because of the look ahead to a meeting between Trump and Putin that could potentially, we hope, end the war in Ukraine. So that's the market reaction. Let's bring back our panel. Marcus Ashworth from Bloomberg Opinion still with us, and we can also bring in Bloomberg's Lucy Meakin. Welcome to you both. Lucy, you and I have been long-time BOE watchers. You much longer than me, it has to be said. That vote split, as I say, was historic. Do you think that this meeting was unusual?
Oh, my goodness, it was so interesting. I mean, I've never seen it. None of us have ever seen it with the MPC. The whole point of a 9-member committee is that you don't really have these things happening. But we had this 4-4-1 split, and it's Alan Taylor who's been very outspoken in how much he wants rate cuts. He sees himself as a monetary activist, and he really was up for a cut. So he was going for that 50 basis points. But I think, you know, Bailey talked a lot in the press conference about how they made it work, and he went to 25 basis points to get that cut through. But really interesting.
Marcus, I've got to say it was Claire Lombardelli's vote that shocked me, given all of her recent dovishness now that she's a hold. You said earlier that this is her true colours being shown. Do you think this is the start of a hawkish Claire Lombardelli?
Yes, I think she always was. Beforehand, we expected her to become hawkish, but she sort of stuck close to the governor for the first few meetings, and now perhaps she's had the courage to move away and be more hawkish, along with, say, Hugh Pill, chief economist. I also think it's interesting that Swati Dhingra is not as dovish as she once was, and indeed Ramsden's moved back in a little bit more into line. So they're the ones I think would probably swayed it. I was expecting a 6-3 or something like that. So in that sense, I do think that the MPC is split, some interesting points of opinion, but clearly the overall impression is they don't really know what's going on. I don't mean that in a rude way. Well, I do really, but I think it's very unclear, certain for them, and they are sticking to their... If in doubt, inflation is a worry. All we can see short-term is higher inflation. That, for them, still trumps evident weakness in my mind on the Labour side and potential downward pressures on growth, both domestically from the budget and internationally from tariffs and all the rest of it. So I'm surprised at this, that they have this view, but what they've really done, they've kicked it forward to November, and we will see probably a more clearly a 50-50 chance there of another cut, but it's not far from certain.
All right, well, Lucy, Marcus says that they're all over the place. Let's just take a listen to what the governor said on the future path for rates.
I do think the path continues to be downward. Yeah, there is, however, genuine uncertainty now about the course of that direction of rates. I'll be honest with you, the point I was making is that I think that the path has become more uncertain because of what we're seeing.
Where traders have paired bets then on the future path for rates, Lucy, where does this leave the path?
Well, I mean, I think, as Marcus said, where are we going to go? I mean, November is now completely in play as a 50-50. I think people were really anticipating that we would get those cuts, and now I think people are really questioning that, and we've seen that in that pound reaction and also in the shorter-term gilts.
I just think that this won't last long, and the fact we're only up, say, 5 basis points in yield at the front end, I don't think people believe in this. I wouldn't be surprised to see, by the time it certainly comes through to September and into November for the next clearly proper live meeting, then we may find that they are pushing again for that expected rate cut more strongly than 50-50, should we say. But I'm a duff for somebody.
I mean, we have, though, seen the yields move up. I know you're saying it's a knee-jerk reaction, OK, but does this leave the Chancellor in a more difficult position? We're looking ahead to the autumn budget. You, in your own words, Marcus, have said she's in a mess of her own making.
Yeah.
You know, do you think that she can afford to raise taxes again in the autumn?
She's going to have to, but she can't blame anyone but herself. It's not the Bank of England. That she's making their life much, much harder. And this is the point, as the last question, which Bailey quite wisely swerved, was that, you know, look, if you're going to raise the minimum wage by 4.1%, let alone what they're going to do with the civil service wages and various other strikes coming through, that she's making her life very difficult. But the Bank of England's even more difficult. So that's why they're doing what I guess they should do, as far as they're concerned, sitting on their hands.
Lucy, the Governor was asked why gilt curves have steepened. Do you think it is fair to say that it's more of an international issue than a domestically caused issue?
I think it's certainly an international issue. We've seen it particularly in Japan. It's been so interesting watching Japan. And also in the US, we had a 10-year Treasury auction yesterday that was a little bit on the weak side, and we're going into a 30-year Treasury auction today, which is going to be very closely watched because people are just so nervy about these long ends. They're nervy about deficits all over the world in those really large, important economies for bond markets.
Yeah, we're looking at the 30-year Treasury yield weaker 2 basis points, currently at 480, pretty steady across the rest of the Treasury curve. But just coming back to gilts and all this commentary on quantitative tightening, Marcus, the line that stood out for me from Dave Ramsden, the Deputy Governor, who, of course, is in charge of markets, says that they're cognizant of developments at the long end.
Ah, at last.
He's not being clear about what's coming in that strategic review on QT in September, but what do you expect?
I think he was being as clear as he could be. And I think the telling line for me was that they acknowledge that between 15 and 25 basis points higher in yields because of their active QT policy. So, I mean, this is madness. You're cutting interest rates at the same time as you're tightening policy on the unconventional side. How does that... That never makes sense. It makes even less sense when they're acknowledging they are actively causing a much higher cost for all of us, taxpayers, the government alike, by this policy. I think what he's telling us is, funny enough, exactly what Bloomberg Economics have written, and indeed a former NPC member, Michael Saunders, had dropped very big hints on. I think he's conveniently done a bit of ground rolling for them, pitch rolling, that they will stop 20-year plus long gilt sales, which is, you know, where the most damage has been done as far as having bought them sometimes well above par and selling them at as low as 25, 30 cents or pence on the pound, which is really not the way of conducting monetary policy. Funnily enough, because no one else in the world does it far from us. Let's hope next time we come and sit to look at NPC meeting, they have at least stopped the long end, if not, and hopefully dramatically reduce the rest of them.
Lucy, to your ear, did Deputy Governor Ramsden just admit that QE/QT has been a mistake?
I mean, I wouldn't think he'd go that far. He's quite a cautious man. But, yeah, there was definitely a feel of that, to be sure.
One of the members of the MPC, I noted, it was revealed in the press conference, I'm sure we'll see it when we go through the minutes, but is concerned about a recession. We don't know who it is.
Well, we can probably guess, can't we? Yeah.
With the initials SD?
Well, maybe, but equally it could be Alan Taylor. So, I mean, I think they've both been fairly conscious of this risk.
But given your concern, Marcus, that the BOE could get behind the curve, do you share that worry?
No, I don't. And I think that the government has pump-primed the public sector side of the economy sufficiently, which a lot more of that will come through. So I don't think growth goes one way or the other. It's just the shift in the economy from the public sector getting all the help to the private sector basically suffering. That's what worries me more. It's the balance within. But will growth still be around 1% as the Bank of England? Probably. So I don't see a recession. And even if it were to be one, I think it would be mild. But it does put the pressure on the Bank of England. I think if they're dragging their heels, if they've got this wrong, they'll be forced at some stage, probably early next year, to accelerate their cuts. But they're clearly prepared to take that risk. And, look, maybe they'll be proved right.
When we look at the Chancellor's reaction to this, Lucy, she's saying it's good news for people wanting to get on the housing ladder, people remortgaging, and also businesses borrowing to grow. Do you think that's a fair assessment of the impact of today's meeting on consumers?
I think that's a very political response. Quite a sunny one, so, it's nice that she's trying. But, yes, I think, as Marcus has pointed out, we're in such a position of conflict between the two sets of policy, and they are just trying to keep the economy going. And, if that means saying that it's good news for first-time home buyers, then fine.
Well, I thought it was really interesting as well, where you had our very own Francine Lacroix putting a question to the governor about the future of Jay Powell, the Fed chair, of course. And, we're looking at the imminent replacement of Adriana Kugler. We've got this question from Francine about the risk to the Bank of England's independence. Bailey didn't want to comment, Marcus, but I wonder if you think that there is a risk of that transatlantic spillover.
Yeah, tell me you think this is a bad idea without telling me. This is exactly what Bailey made that very, very clear, that he was very much on Powell's side against this, which, look, the governor is world-class in one thing, which is blame avoidance and making sure his own position is very, very comfortable. So in that sense, what else would you expect him to say? But the fact he re-emphasised it several times, I thought it was a very brave question from Francine. I thought he'd bat it straight away. But he made it a particular point to keep on saying how of the utmost integrity Jay Powell has, which he absolutely does. But to emphasise it so much is sending a very loud and clear message. I'm not sure he'll be invited to a free round of golf at Turnberry in the future, is what I'm saying.
Lucy, what did you make of it?
Oh, I enjoyed it very much. We had quite a lot of question avoidance today, actually, I thought. But he was very keen to point out what great friends they are, and it's always interesting.
Well, of course, they'll be uniting at Jackson Hole, and we'll have full coverage of that right here on Bloomberg Television. But Bloomberg's Lucy Meakin and Marcus Ashworth of Bloomberg Opinion, we thank you both so much for all your analysis. A quick reminder that our very own Francine Lacroix will be speaking to the Bank of England Governor Andrew Bailey later. We're going to bring you that conversation from around 4 p.m. UK time. But that does it for our coverage of the BOE rate decision on TV, radio and online. A cut after an unprecedented revote from the BOE. But we'll go back now to Bloomberg Surveillance. They're speaking to Seema Shah of Principal Asset Management. Thanks for being with us. This is Bloomberg.
That started in Texas. Meanwhile, President Trump will sign an executive order today to allow private equity, real estate, crypto, and other alternative assets in 401ks. The White House confirming the order will direct the Labor Department to reevaluate guidance around alternative asset investments in retirement plans.
Hi, my name is Matt, and today I'm here to tell you all about Replit in just 60 seconds. Replit is the fastest way to go from idea to application. It's the most secure, professional way to vibe code. It's the perfect place to prototype your next idea or even build your first app. Replit allows you to build and share amazing ideas with just natural language. It lives in your browser, so there's no installation or configuration necessary. You can use Replit Agent, our AI native developer, to bring your ideas to reality with just a single prompt. Even if you've never built or deployed an application before, Replit's AI native tools can help get you there. We take care of all the hard stuff. That includes things like storing sensitive data or secrets management, storing data persistently, like databases or object storage, and even deploying your application. These tools are all built into Replit in a secure, safe environment. When you're happy with what you've built, Replit deployments make it easy to take what you've built and deploy it live to the internet in just a few clicks. Best of all, with our mobile app, anything you can do on Replit.com, you can do on your phone. Again, I'm Matt, and this has been Replit in 60 seconds.
5 a.m. in New York City. Good morning, I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. It's go time. President Trump's sweeping new tariffs kick in. Switzerland and India get hit with some of the highest rates. A threat and an exemption. The president announces 100% chip tariffs, but zero for the likes of Apple who invest in the U.S. And the Fed's outlook. Trump says that he'll name a temporary governor, while 3 other Fed officials signal that it's time to adjust rates. And we are higher this morning despite the fact that at 12:01 a.m. we had tariffs kick in, despite the fact that chip makers are going to get 100% tariff. But there was a key exemption. If you invest in the U.S., you'll get 0%. And that's maybe why we're seeing the rally underway this morning. We're up by more than 0.5%. By the way, the Mag 7 hitting another all-time high yesterday. For this bond market, a little bit of a different driver. It was the Fed speak. Kush, Kashkari, and Daly all out yesterday talking about it is time to adjust rates. So we had a front-end rally. Little change this morning, but still we are slightly lower with your front-end yields at 3.70 for the 2-year yield. The long end was under pressure yesterday. We had a pretty dismal bond auction for 10-year yields. That's at 4.23. We'll get a 30-year auction today. Let's get you some stocks moving in the pre-market, including those chip makers. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Yes, let's start with TSMC, the largest chip manufacturer based in Taiwan, really cheering these tariff exemptions. Those shares are up 5.2%. I know you mentioned that Mag 7 was trading at record highs. We also have TSMC trading at record highs in the back of this optimism that now we don't have to worry about these sectoral chip tariffs. Let's move on to the broader tech industry because we are decently in the green. I want to start off with NVIDIA, one of the biggest out there, up nearly 1%. Apple up nearly 3%, Danny, and this comes after it had its best session since May, up 5% yesterday, adding to that again in pre-market as it gets those tariff exemptions. Global Foundries, this is also related to Apple. Those shares up 9% in the pre-market. This is something that they're increasing their ties to Apple. That was announced yesterday. Now, Global Foundries is a chip manufacturer, has 3 manufacturing sites in the U.S. As you can see, the reason why Apple wants to build more of its products in the U.S. and Global Foundries is going to help it do that. Let's move on to one more stock that is moving lower after earnings, and that is Airbnb. This is the hotel booking website, down 5.7%, Danny. This comes after, even though their results did come in with a beat for the previous quarter, they gave quite a modest guidance on the year ahead, saying that they're going to face some tough comparisons year on year through the remainder of the year. Danny.
Valerie, thank you very much for this roundup. We'll catch up with you later in the hour. Also in this hour, we'll speak with Nandini Ramakrishnan of JP Morgan, who joins us to look at the impact of Trump tariffs on emerging markets. And we'll discuss how questions of the economic data integrity and a new Fed governor will affect the outlook with Terry Wiseman of Macquarie. But first, our top story. After months of threats, reversals, talks that led to deals and talks that haven't, President Trump's sweeping new tariffs are officially in effect. Joining us to break down the key details is Bloomberg senior editor Bill Ferries. So, Bill, the tariffs are being implemented just on an overall basis. How much confusion, how much certainty is there as they start to work their way through the system?
Well, there was a rush to get goods on their way before that midnight deadline last night in the U.S. Average U.S. tariffs are now up at over 15% compared to just about 2% when President Trump took office. So that is going to have a huge impact sooner or later on the U.S. economy, global trade flows, and the global economy. We haven't seen a huge influx or increase in inflation so far in the U.S., but we have seen from some of the latest economic data that the economy appears to be nearing more of a stall speed when it comes to things like job creation. So the impact is probably starting to filter through, and the expectation is in the months ahead, we're going to see that tariff hit start to take effect.
In terms of the haves and have-nots, Bill, in the latter category, there's the likes of India and Switzerland that are facing really punitive rates. What went wrong?
The risk manager for prop firm account, algo and manual trading, the settings, reset time, deposit amount, max daily loss based off amount or percent. If percent, you can choose between Binance, equity, or the highest between the two. Max daily profit or consistency rule based off amount of percent. If percent, You have balance, equity, or the highest between the two. Max drawdown, base of amount or percent. Profit target, base of amount or percent. Max number of trade per day. News filter, you can choose between high, medium, and low impact news or the combination between the three. Time of day to close trade and stop trading. Day of the week for trading. This is Equity Protector, the link in the description below.
Ketika tubuh membutuhkan cairan secara cepat, elektrolit dan karbohidrat yang hilang perlu digantikan. Dan sistem kekebalan tubuh harus diperkuat. Minum UC 1000 Lemon Water atau Orange Water. Minuman isotonik unik dengan 1000 mg vitamin C.
Yeah, well, first on India, I mean, that has been a 180-degree turnaround from what I think most of us expected maybe 3-4 months ago. The administration was talking about India being near the front of the line. President Trump and Prime Minister Modi have a close, or had a close personal relationship going back to Trump's first term. It seems like the more President Trump focused on Russia's continuing war in Ukraine, the more he looked at things like the BRICS bloc and some of their moves to separate or limit trade with the U.S., the more frustrated he got with India. The relationship has really kind of broken down. India has avoided escalating the situation, but right now they're looking at potentially 50% tariffs in 3 weeks' time when this extra 25% kicks in. And then you have Switzerland, which failed. Their president failed to get a meeting with President Trump when she visited the U.S. this week. The 39% tariff is the highest among industrialized nations. All of Switzerland's neighbors, or many of them, are paying as little as 15%. So that's going to create a huge competitive gap that Switzerland's going to struggle to deal with.
And when it comes to the question of Russian oil, Bill, it's interesting because it really feels only like India that's faced this scrutiny. China certainly buys Russian oil too. How are discussions evolving there when it comes to China and their tariff rates?
Yeah, I mean, China actually buys more Russian oil, about 2 million barrels a day, than India does at 1.7 million. President Trump has really not focused on the Russian oil component of Chinese trade so far. He wants a deal. I think the big difference between these two countries is with its rare earth magnets and its influence over that market, China has a lot more leverage over the U.S. than India does. There's no comparable key product for India that it sells to the U.S. So that's been the difference. The president has said that maybe he'll consider the Russian trade when he deals with China, but I think he's got his eye on a bigger picture trade deal, and he's talked about meeting Xi Jinping to sign that deal later this year.
Bill, thank you so much for this. So much to go through. Helpful to have you on. That's Bill Ferries. Let's stay on trade, though, because Apple and chip stocks, as Valerie was laying out, are in focus and rallying this morning. Apple adding another 3% onto its rally from yesterday. The president announced further plans for his sectoral tariff regime yesterday. Speaking in the Oval Office alongside Apple CEO Tim Cook, Trump declared that he would slap on eye-watering tariffs on semiconductors.
We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge.
This, Roz Matheson joins us now. Roz, how would these exemptions work?
Well, it's very unclear how they might work and whether, in fact, Donald Trump just kind of floated this in the minute when he was having that meeting with the Apple CEO. Does he mean on chips coming in to the US, a couple of big chip makers really around the world who have a lock on the global market and are already rushing to show that they're investing in the US. So would they get an exemption? Is it separately to that anything that is an electronic device that's brought into the US that contains a chip? It's very, very unclear exactly what Donald Trump was meaning, but the fact he even talked about carve-outs, exemptions for these companies that are investing in the US suggests that a large slice of the market might in fact get an exemption. That's why you're seeing a pretty low-key reaction in the market today. But if you look underneath that, are there mid-tier, smaller-tier chip companies, including particularly in Europe, who might actually find themselves vulnerable in all of this? We're trying to understand all of that today because underneath those exemptions, there are companies that are potentially quite impacted.
And there are companies that maybe have found their way to the exemption. To your point, Roz, Apple seems to be one of them. You can see shares up 3% in the pre-market. They rallied 5% yesterday after talking about investing in the U.S. But Roz, what sort of moves are Apple and other companies having to make to try to skirt some of the supply chain pressures and make sure they're on the White House's side?
Well, it's interesting to see the playbook that company executives seem to be using in the US. We saw that even at Donald Trump's inauguration, where they're all lined up in a way paying homage to him in the minute and getting this idea that Donald Trump is essentially a businessman. He's a showman. So they're turning up at the White House, having their meetings. They're promising investment. The interesting thing is in all these vast amounts of money that are being promised by companies to put operations, manufacturing, factories and whatnot in the US, how much of it has to actually eventuate in the end? Are they promising stuff that they've already pledged previously and they're rebundling? Are they promising factories and other buildings that could take many, many years to build and may never actually have to build? The question is, of all this money that's being pledged, how much is going to be a reality, but how much actually matters in that for Donald Trump? Really, for company CEOs, it's about realizing the playbook that you need to operate with under this administration. And the main thing, of course, is to show that you're hearing Donald Trump on his messages and you're really promising you're going to bring jobs, manufacturing and business back to the US.
Roz, while we have you, because it's not just been companies that have been promising investments, it's the likes of countries too. And where you sit in Europe, many countries have also promised the same thing. In fact, that was part of the deal with the tariffs with the EU. Do we know how that's playing out with tariffs officially kicking in?
Well, the interesting thing in all this, again, is the question of what it means more broadly for trade globally, what it means for businesses. Can investment come in to the US? But obviously, you know, for global companies looking at this, as Bill was saying a minute ago, the impact on the US economy is still very unclear, and therefore on the global economy is unclear. So do we see a rise in inflation at some point? Do we see supply chains being completely reorganized around the world as a result of this? But certainly you can see if you're a CEO, if you're a head of state, you're all still trying to work out exactly how it is that you do business with Donald Trump under this administration.
All right, Roz, thank you very much for that. That is Bloomberg's Roz Matheson. Let's now get you some other top stories that are trending on the terminal this morning. The Kremlin has confirmed that President Donald Trump will be meeting Russia's Vladimir Putin within the next few days. Putin met with Trump's envoy, Steve Witkoff, yesterday in the Kremlin for nearly 3 hours of talks. The U.S. is pushing for an end to Russia's war in Ukraine. 3 Federal Reserve policymakers, Mary Daly, Lisa Cook, and Neil Kashkari, have voiced concerns yesterday about the U.S. labor market. They pointed to a potential interest rate cut in September. Kashkari expects the Fed to lower rates twice before the end of 2025. Daly said 2 cuts are likely appropriate this year, but the Fed may need to cut more than twice. And the Bank of England is set to cut their own interest rates today. It would mark the lowest level in 2 years. Policymakers are contending with a slowing economy and a jobs market rattled by higher taxes. Economists predict a 3-way split on the committee, with the majority supporting a 1/4 point reduction. Coming up, high tariffs for India and other emerging markets loom. JP Morgan's Nandini Ramakrishnan will be joining us next for the read through to markets. Stay with us on your brief.
Everything is possible. Isn't that right, Seoul? Absolutely, in Seoul.
भारत Semiconductors, if you're not building like $100 billion plants in this country, that would further upend a global electronic supply chain undergoing a seismic shift already following decades of reliance on China. And the president telling the CEO of Intel, Lip-Bu Tan, to resign following concerns around his ties to China. As you can see, Intel shares, which have already been battered in a company which is a shadow of its former self, down another 3% today. Katie?
Let's wrap it all together now with Bloomberg Tech co-host Caroline Hyde, who joins us on set. So, Caroline, I want to start with Intel because Lip-Bu Tan, he only took the helm in March 2025 or so. Now you have the president of the United States calling for his resignation. As I understand it, this traces back to his ties to Cadence.
His ties to Cadence, but also his ties to Chinese semiconductor giants. He was on the board of SMIC, which is one of the #1 chip producers over in China previously, and his venture capital firm that he founded has made plenty of investments in Chinese companies and Chinese-related companies and Asian companies writ large. He's born in Malaysia. Look, none of this is a surprise. There was much reporting done on his ties to China when he did become what many would say a surprising savior of Intel. But Trump today really highlighting this, saying, look, he's highly conflicted. This is after Republican Senator Tom Cotton yesterday asked the chairman of Intel's board to answer questions about Lip-Bu Tan's ties to China more broadly. Now, I will add, Intel responded to that letter from Tom Cotton saying Intel and Mr. Tan are deeply committed to the national security of the United States and the integrity of our role in the U.S. defense ecosystem, because this is what Republican Cotton had been pointing to, the $8 billion of money coming from the U.S. government, coming from the CHIPS Act, to basically build manufacturing here in the U.S. that would supply the U.S. government and armed forces. Does that conflicting potentially be there if he's still related to Chinese entities? We need to understand how much he still has investments in them, how much he's been selling them off, and more broadly, what his relationship was to Cadence as well. That's right, you brought that up, that was something that Tom Cotton had been concerned about them pleading guiltily, as he quoted, illegally selling products to Chinese military university and transferring its technology to China. And of course, he was once the CEO of Cadence. So a lot still to be built there. Shares are only off by 2% now, though.
I was listening to President Trump yesterday and was surprised when he said he was going to put a 100% tariff on chips. You know, he's come out with these big numbers before. He said that when talking about India previously, and now it's only 50%. What's the likelihood that we get that kind of tariff? And then if he does allow companies who invest in the U.S. a carve-out, who else is going to get it besides Apple?
Well, thus far, we understand Samsung's got a carve-out. We understand TSMC has got a carve-out. So Korea is saying that SK Hynix has a carve-out. All these whopping big technology companies have sort of front-run this. Think about how much TSMC has been building manufacturing in Arizona, how much they've been flying out to Mar-a-Lago and to meet President Trump to commit yet more and more capital into the United States to ensure that, rather like a Swiss cheese, you have all these holes peeled out of what would be a blanket 100% tariff. But the questions still roll. How much Apple, for example, yes, it gets a carve-out on its phones because they've committed yet another $100 billion in US manufacturing. But what of those iPhones that are still being made in India and the ongoing tariff concerns there? What of all these smaller other companies, international Asian giants? Remember, most companies don't actually manufacture their own chips. They manufacture them with TSMC, but others in Asia. And what about all the products that cars that I know you so love, Matt, auto industry, they have all the semiconductors in. Are you going to tariff them? There's really no end to the questions here thus far, but it does look like some of the major tech companies in Asia have got a carve-out, and that's why the market reaction has really been pretty muted.
I mean, if Samsung and TSMC get carve-outs, and they import almost all of the chips to the U.S., then we're all good. I wonder if Ford or GM will get carve-outs for steel tariffs then and other things that are hurting them. Caroline, I'm sure you're going to cover this all on your program. Bloomberg Tech starts at 11 a.m. Wall Street time. Definitely tune in to see more from Caroline Hyde and Ed Ludlow. Let's bring in now Morgan Stanley Chief U.S. Equity Strategist Mike Wilson and Bloomberg Intelligence Global Head of Tech Research Mandeep Singh. Mike, we'll start with you. So happy to have you as our guest co-host for the hour. What do you make of this announcement? As I said to Caroline, we've heard from the president before, 100% tariffs, and then we get a smaller number later. Do you really think we're going to get 100% on chip makers?
Well, no. I mean, this is how we've laid it out. We've said this all along at 232. There'll be carve-outs. This is exactly what we're getting.
I kind of like the Swiss cheese analogy. You know, there's definitely holes to get away from this, but it requires investment, and that's really what this administration is trying to do, is trying to encourage investment in this country for manufacturing of all kinds, and chips is just one part of that. I want to bring in a theory or a thesis that we've had all year, which is that so Trump came in. You know, President came in this time as like a new CEO, right? He came in, he kitchen sinked the first quarter, did all the bad stuff, the kind of growth negative stuff, and then now he's doing the pro-growth things. And tariffs are kind of the same way to think about this, right? It's like a company that sets the bar, you know, they set and then they beat and raise. So you set a low bar, so he's setting 100% tariffs. He can beat that pretty easily. And that's how the market's trading now. And it's to the point now where the market isn't even selling off on this headline because they know that's a sandbag number, just like a CEO would do.
And Mandeep, I really want to get your perspective here, but I have to follow up on that because that's a nuanced interpretation of the market reaction to these tariff levels from where I'm sitting and from where others are sitting, judging by the notes that we're getting on Wall Street. It just seems like people are exhausted, that there's fatigue around the tariffs, and that's why maybe they're not really causing these big reactions to these headline numbers.
Well, but there's one fact that you're missing in that, which is the earnings revision breadth, which has been the thesis of our bullish view since April, has gone straight up and to the right. So what is that all about? What that's about is that in April, basically companies and analysts discounted much higher tariffs. So now we're getting tariffs that aren't quite as bad. They're still higher than we were at the beginning of the year, of course, and we're collecting revenue on that, but they're not as bad as what was priced into the earnings. And so we're getting this reflexive move off of those lows, and that's also what stocks are reacting to.
It's a taco take, essentially. I mean, without being so mean about it, right?
Well, no, I don't agree with that. I think this is the way he negotiates. I mean, he basically puts a high bar and then he negotiates something in the middle. That's a negotiating tactic. I mean, it's well known. I mean, I learned this in business school 40 years ago. You know, like it's the BATNA approach, right? You set the bar here and with the hopes of settling somewhere in the middle.
So that is the investor perspective. That is the market perspective. Let's talk about the corporate perspective. You see shares of some of the chip makers higher today, NVIDIA, AMD, for example, Intel in its own special world right now. I mean, how do the executives deal with this sort of approach that Mike Wilson is laying out here?
I mean, look at Apple, right? Last night they had announced $600 billion in CapEx over the next 4 years. Now, when I look at it from their perspective, it's going to have a hit on their gross margins. How else can you explain an asset-light company having to invest, $150 billion a year in CapEx, which is similar to, by the way, the other hyperscalers. They'll be spending $100 billion, but in data centers. Whereas Apple is setting up these facilities, and they won't have any revenue growth to show, unlike, an Amazon, Microsoft, or Google, where they will have revenue growth from all the data center investments that they're making. So from that perspective, Apple has the ability to invest in data centers because they can vertically integrate like a Google, with their TPUs. Apple makes chips. They can make that sort of investment, which will have a much higher ROI than replicating what TSMC and Foxconn have done in China, Vietnam, and India. And so from that perspective, I do see a hit to Apple's gross margin, given they will be forced to make investments and they will diversify their supply chain in the process.
If, Mandeep, they actually do invest that much, right? We've heard so many giant numbers out of not just companies, but countries. Japan is going to invest $600 billion. The EU is going to invest $550 billion. And a lot of the officials from those countries are saying, no, actually, that's not going to really happen. Is it possible that Apple is just giving us this huge headline number and not really likely to follow through over the next 4 years?
I mean, next 4 years, you said it, right? So you can kind of work your way around it for maybe a few months, but then they will have to show some progress with regards to their CapEx investments. And the administration and president were very clear that if these companies don't follow up, they'll make him pay. And so from that perspective, they announced a glass factory, right? So the question is, what else are they going to bring onshore? And to my mind, if you're not bringing advanced node manufacturing, which TSMC has already put so much money in Arizona, what else are you going to do with that $150 billion in CapEx? Data center seems to be the most obvious choice. But right now, Apple hasn't mentioned that. And I'll be curious to see if they go towards that data center investment.
Do you think that the productivity of that investment is going to be the same as what we saw in Taiwan as some of the pushback? And I think even they've said that, the manufacturers themselves, that the labor isn't here to do that high-end type manufacturing.
Yeah, I mean, so they're going to go at the supply chain level in terms of individual components. So glass was the easy one where they could partner with Corning. I expect them to do something similar with other components that go into a phone. And so that's where they're still going to rely on their existing suppliers. I don't envision them, picking a new set of suppliers to set up the operations. They're still going to rely on a Foxconn or a TSMC to do it. And so that's where I want to see what part is coming from TSMC's CapEx versus what part is coming from Apple's CapEx, because that $150 billion a year number is huge. And if it's not data center or power related, what is it going to? Because the supplier parts are not that big in terms of, the addressable market.
Well, I am curious. I mean, reading these stories, thinking about these numbers and how just much spend that these companies are committing. Mike, do you think it ultimately matters whether or not they spend that amount over the next 4 years or so? You think about the example of Apple yesterday offering this olive branch to President Trump. The stock went up. You think about Intel today coming under criticism from President Trump, having a pretty bad morning. It seems like, when looking at companies, you also have to care about what their state of the relationship with President Trump and this administration is, and whether or not they happen to be in good graces at this moment.
Well, let's just talk about where we're starting from, right? Which is that capital investment, domestic capital investment in this country has been on a downswing for the last 20 years, really since the last tech cycle. So, we got to jumpstart it, right? And that's what the tax bill is all about. That's what these deals are all about. Let's jumpstart this. Let's see where we can go, because right now there's no capital investment going into the United States. That's why we've lost so many jobs. That's why we've deindustrialized. I mean, this is
Wasn't that what the CHIPS Act was about?
Sure, but this is part of that same idea, right? It began with President Trump's first term. This is not a new development. Now it's just going into kind of turbocharged mode. It's very disruptive, okay? But this administration has been very clear. We have to reindustrialize America, okay? That is the initiative. Whether you agree with it or not, that's where they're going. And we have 2.5, 3 more years of this before there's going to be a change in that.
All right, Mike, you are sticking around for the next 30 minutes or so. Mandeep, we're saying goodbye to you. That is Mandeep Singh of Bloomberg Intelligence. A really interesting conversation on chips. We do have some other movers on our radar this morning, though. We're in the thick of earnings season still, and Hertz surging as it secured all of its 2025 fleet at pre-tariff pricing. Shares up 16%, Matt Miller.
Yeah, it's a big deal also because they sell cars. So if they've bought them pre-tariff and they sell them post, at least in the short term, that's a little bit of money made. Celsius also reported record sales following its Alani Nu acquisition, and up 24%.
Yeah, not impacted by that high noon kerfuffle, it seems like. Let's talk about Crocs really quickly, because Crocs down 20%. Its sales were in line with estimates, but it's only providing guidance for the current quarter due to global trade uncertainty. That is certainly the case across industries, but Crocs down 20%.
I'm surprised. Crocs seems to be like the airport footwear of choice these days.
Yeah, I see a lot more of them than I used to, but who knows?
Coming up, Eli Lilly plunges. We're going to digest the latest weight loss pill data next. This is Open Interest.
Yuck.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will
grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back to Open Interest. We've got our eyes on Eli Lilly tumbling in the pre-market as disappointing data on its new weight loss pill overshadowed otherwise strong growth in its current obesity medicine. Joining us to discuss is Bloomberg's managing editor for global business, Shelley Banjo. So, Shelley, quite a decline in Eli Lilly this morning. When it comes to the weight loss results that we got for the pill, is it the side effects? Is it the actual number of pounds that people shed? What exactly is Wall Street latching onto here?
So it's all about the future. The pill is the future. How are we going to open up this market even more for people who feel a little queasy about taking a shot every single week? And so the idea is, how big of an impact is this going to be? So it came in at the low end of what Wall Street was expecting. It didn't, completely blow things out of the water, but it was just on the low end. And so Wall Street's saying, you know what, maybe this isn't going to be as big of a deal as we had thought, at least at the beginning.
In terms of weight loss, right? But when I heard this news, I was like, yes. Like 11% is exactly what I need to lose, and I don't want to lose 20% of my body mass. But I was also hoping that that meant the side effects would be somewhat lighter as well. And that's not the case, right?
Right. The side effects are pretty much the same. You got about 10% of people dropped out of the study because of the side effects in general. So the same as the shots. So no worse than the shots, but no better than the shots either. So the pill might be easier to pop, but it still can hurt you, can mess with your life, your day-to-day life.
Mike, you're in great shape. What do you think about this? What do you think about this GLP-1? I mean, you can't deny that Americans need something, and they're not going to start eating well and exercising for the most part.
Yeah, well, I think it could be both, right? So I think this is a godsend. This drug as a pharmaceutical is great for folks who have diabetes and are just chronically overweight. That's a great start. But I think it's a dangerous road to go down, and I think this is what RFK Jr. has said. The head of the HHS. He wants to have a balance. Better diet. A little exercise. Let's work in the presidential medal again for fitness, right? Both mental and physical fitness. Those are you got to do both. You can't just rely on a pill to solve all your problems. And so, but I think it's a great product.
But that's
has shown success.
You're saying from a consumer point of view. What about the business? What do you think about selling these drugs, and how does it affect the broader economy? Like we were talking about McDonald's yesterday, which the shares were up yesterday, but.
Yeah.
There's no doubt. That has played through. So that was obviously a story last year where you're seeing less consumption of all kinds of things, even alcohol, right? So this pharmaceutical does reduce consumption of a lot of items, and the market has priced in a lot of that. I don't think this is going away. It's a setback, perhaps. Okay, but this, it works. A lot of people have had a lot of success with this drug, and as you said, America needs help with this issue. So I think it's going to continue to probably be a growth area. There's going to be other alternatives. They're going to fix the side effects probably over time, and hopefully it doesn't have other side effects that are more debilitating.
It's been really interesting watching this theme develop because it feels like investors are so focused on AI. That is the theme that dominates all the themes, but a lot of folks have latched on to that narrative around GLP-1s, what that could mean, and you're certainly seeing that being expressed. I do want to talk about healthcare broadly, though, because you take a look at the sector performance year to date, healthcare at the bottom of the pack, down about 5% year to date. this was one of the bull cases coming into 2025. The idea was that you were going to get maybe looser regulation similar to financials, and maybe we're going to see some consolidation. And it just feels like that hasn't played out.
Well, I think what's going on is that they're waiting. We're waiting for what the changes are going to be. So even in the first quarter, when defensive stocks really outperformed, healthcare did not. It lagged. And that tells me there's this cloud. And I think, you know, going back to RFK Jr. again, he said that they're doing their data analysis now. They're going to roll out something in September. We're looking like late September, early October for what is the grand plan here, like what is going to happen. And let's not forget the insurance companies, right? The HMOs have been under major duress, okay? And that's how these companies get paid. So there's just a lot of noise right now in the space. We don't have answers yet. And just like with tariffs, we're going to get more information over the next 3 or 4 months. I think what we could see is regulations and things come out in September, and that's actually almost a sigh of relief for the group to start working again. Because there are great companies in this space that are growing. Okay, this is not a defensive sector that has no growth. There are avenues of growth in the healthcare space, and there are companies that have technologies to drive that growth.
Yeah, I mean, this year to date, I mean, Novo Nordisk and United Health are not representative of the whole industry, right? So.
Yeah, but Eli Lilly, that was the shining star. So to see that down year to date, it's going to be, once markets open, it's going to be even more dramatic.
All right, Mike Wilson is sticking around. Shelley Banjo is going to keep us apprised of matters as we get more developments on this Lilly story. And let's get to some of the other movers on our radar right now. Airbnb issued a solid outlook despite warning that growth may not be sustainable. And
Peloton.
A massive buyback.
Yeah.
Did Airbnb not come out with like a $6 billion buyback last night?
If they did, it did not help because shares are down more than 7% pre-market. I want to talk about Peloton, though. We were just talking about exercise, and Peloton projected a sales decline for the current quarter and will cut jobs to reduce costs. Shares up 3.8%. Maybe people like that cost discipline. I will say that I just bought a Peloton, so.
Too much Ozempic.
Too much Ozempic.
I'm down for some Krispy Kremes, although the sales disappointed maybe because of Ozempic as demand fell in the U.S., Europe, and Australia. That was the theme anyway, but they are just delicious. Do you not enjoy a Krispy Kreme donut?
Our office is right across the street. It's dangerous.
Nice. All right, we'll be back with more. This is Open Interest.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Welcome back to Open Interest. We are minutes away from the opening bell. Here's your setup. Green on the screen all the way down. The S&P 500 higher by about 0.6%, building on that rally that we saw yesterday. Big tech leading the S&P 500 up about 0.8%. It's the small caps that are the shining star today. The Russell 2000 higher by about 0.9%. Of course, we'll talk about whether or not that will hold, and we'll talk you through all the opening action up next with Morgan Stanley's Mike Wilson after the break. Don't go anywhere. This is Open Interest.
Break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Just moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at gains in futures. Markets not deterred by the 100% tariff President Trump announced he may put on semiconductor importers. S&P futures right now up about 0.5%. NASDAQ futures gaining even more, 0.75%, and the small caps up almost 1 full percent. Great news for these markets. We have a couple of IPOs ringing the bell. It's been a long time since that's happened, both at the New York Stock Exchange and the NASDAQ. C1 fund is like a closed-end fund, so not as exciting as Firefly, which is a space company, a rocket scientists. They're ringing the opening bell down at the NASDAQ market site, and we are going to talk to the CEO in just about 1 hour's time. So this market is alive and well.
It's alive and well. Excited for that conversation. We'll probably have more videos of rockets. So
I hope so.
Stay tuned for that. But let's talk a little bit about Eli Lilly because shares now down 10% at the opening bell. That's after it reported disappointing data on its new weight loss pill, overshadowing that strong growth from its current obesity medicine, that injectable. Shares down 10%. Shares have been lower year to date, just by about 3% through yesterday's close, so really taking a bite out of 2025 performance.
Yeah, getting absolutely decimated, and I guess investors had been banking on the pill doing much better. So we're also watching chip stocks today. President Trump's threat to impose a 100% tariff on semiconductor importers further upends a global electronics supply chain that's already undergoing a seismic shift. That sounds so dramatic when I say it like that. Following decades of reliance on China. Speaking of, President Trump is now telling Intel CEO Lip-Bu Tan to resign on concerns about his ties to China. You can see NVIDIA's a gainer this morning. That helps the market. Taiwan Semiconductor putting up a fab in Arizona, and, well, Intel down another 1.33%, but it's already, as I said, a shadow of his former self. We're back with Morgan Stanley's U.S. equity strategist, Mike Wilson. And, Mike, a couple IPOs there get me excited because, you know, we've been waiting for this market to bounce back in that sense. When we saw the bank bonus story earlier this week, I noticed debt underwriting guys are getting paid, equity underwriting guys not so much. Yep. Is that going to change?
Well, debt usually leads, right? So, I mean, that's what's been going on. The private loan market's been very busy. You've seen a lot of recaps, too. So that's how it starts. And this gets back to our overall thesis, Matt, which is that, you know, we believe we've been in sort of a 3-year rolling recession, and that the end of that recession ended in April with the tariffs. That was the final capitulation. So we think that's a new bull market, right? We think the bear market ended in basically April. It was a pretty nasty one. There were several, you know, along the way, and that was the final flush. And now we're in a new bull market, and capital markets activity is just another sign that that analysis or that conclusion is probably correct.
A new bull market. That seems like a pretty big statement. And what does that imply of what the road ahead looks like? I mean, you think about now through the end of the year, we've heard a lot of folks say that, okay, maybe we get a dip. Maybe we ultimately finish 2025 higher from these current levels, but expecting some volatility on that path.
Yeah, but that's different. Volatility in a bull market or bear market is normal. I mean, you want to see some consolidation. I'll go back to 2020, you know, that's probably when we were probably the most out of consensus bullish as we are today, like on earnings. So in the spring of 2020, we were very bullish out of consensus because of our earnings work, and our work's telling us the same thing. In 2020, it was a straight line up, right? Didn't really let anybody in until September, and then we had a consolidation for about 6 or 8 weeks where we had 2, 8, 10% drawdowns, and we went sideways. But if you look at the chart, it's not even perceptible, okay? So consolidation, volatility, correction, I hope we get some. That would be normal, as opposed to just sort of going straight up and going parabolic here. So I think that's normal. I expect it too. We've said that in the third quarter. We think this is the best chance we could have for some correction or moderation, if you will. But I want to be very clear, it's still early in the new bull market, so you want to be buying these dips.
Well, and there is some frothiness, right? It sort of feels like silly season when you look at how much Mark Zuckerberg is paying people to come on to his super intelligence unit, right? $100 million bonuses. And then you get something like Palantir, which has forecast sales of $4.15 billion, and it's worth $415 billion. Like 100 times sales is pretty nutso, right?
Yeah, no, I mean, I think it'd be naive to sit here and say it's not getting a little frothy in parts of the market, but that's what new bull markets do, right? I mean, and even in existing bull markets, you get frothiness, right? Just like you get over pessimism in bear markets like we got in April. So I think it's part of the deal, right? And as investors, our job is to find good risk rewards, okay? And by the way, you know, a portfolio can have some speculative assets in it, right? It just shouldn't be 40% of your portfolio. And so, like, but right now, I'd say the risk reward still looks pretty good where the revisions are positive, things like industrials, things like financials, parts of the technology sector. You know, these are areas that are continuing to show positive earnings revision breadth, and there's definitely still value in some of these pockets.
So we were talking about froth. Remember, we had meme mania reignite just a couple weeks ago, which definitely was a sight to behold. When it comes to this new bull market that we're in, what do you need to cooperate? I go to the bond market, for example. I see 10-year yields at 4.23%. We had been hanging out around 4.5%. It seems like we've reset a little bit lower here. Are these the levels broadly that you need long end yields to stay in for this bull market to really flourish?
Yeah, 450 has been the level we've been talking about for several years. When you get above 450, equity multiples don't particularly like that. So 423, it seems like we're in a fine zone. I think to continue the bull market, you need the things you need, the ingredients you need is positive rate of change on growth. Okay, we have that from an earnings standpoint. And you have policy that isn't inhibitive, right, or inhibiting that growth. So both fiscal and monetary policy looks like it's okay. And it appears as if the Fed, maybe they're not going to cut in the short term, but all signs point to the next move will be a cut. So you have supportive policy, you have positive rate of change, you have good flow dynamics. I mean, those are all the ingredients you need.
We had a chart on Bloomberg Intelligence earlier this week showing second quarter earnings expectations, and it's pretty amazing. You may have seen it. It just starts to come down at the beginning of the year because we were so pumped up, right, for Trump 2.0, and then after Liberation Day plummets, but it picks up and goes hyperbolic. Do we have that chart?
I hope so.
I said, do we have that chart?
It's like a U.
Will
Just
said, yes,
picture
we have
a
that
U.
chart. Where's the chart?
Yeah.
There
we
it is.
go.
Yeah. Is this what Q3 and Q4 expectations are going to look like too? What do you think earnings turn out to be at the end of the year?
Well, look, this is probably where we've gotten things really right this year. Right? We came in this year, we said there's going to be, earnings are going to come down first because of policy, the sequencing of policy is going to be growth negative. And we were still finishing off this deceleration in AI CapEx. Plus the dollar was a little bit too strong. And everything sort of bottomed in that April timeframe at the same time, whether it was AI CapEx, the sort of burden from tariffs and the pressure that was having on revisions, the dollar was weakening at that point. So that's what's driving that. And let's not forget that companies were lowering the bar. That's what they do. Just like I talked about President Trump with the tariffs, right? He's setting the bar and then he beats the bar. Well, companies do the same thing. So that pattern is normal, is a little more extreme this time because of the dip we saw in April. Third and fourth quarter, and we've been pretty vocal about this, third and fourth quarter is where you won't, probably that's where the risk of the tariffs start to flow through the cost of goods sold, okay? So I don't anticipate that kind of a rebound like we saw in Q2.
So we will take a tariff hit in Q3 and Q4.
We should take a tariff hit on the revision factors, okay? It doesn't mean that earnings estimates have to get hammered for next year. It just means the pace, the rate of change, the second derivative could roll over for a period of time. That is a potential risk in the third quarter for a correction consolidation that we were talking about earlier.
And a risk to Fed cuts?
Well, risk to Fed cuts comes next week with the inflation data, okay? And I think this is part of the reason we sold off on Friday is that we had a really weak labor report, okay? It didn't really shock us, but it was weaker than expected. And the Fed is on hold, meaning that reaction function now is being driven by their concerns about inflation, so they can't react to weak labor data. The market didn't like that for a day, a day. And now it's saying, well, but ultimately they're going to get there. So I'm going to look through it.
It was also the revisions. It wasn't just one report. It was those really ugly revisions that I think shook sentiment as well. Mike, we're up against the clock. You've been so generous with your time this morning. Great time speaking with you. That is Mike Wilson of Morgan Stanley. Let's get a quick check on this market. We're just about 9 minutes into the session on the S&P 500. You can see breath is booming in a good way. You have more than 400 names in the green right now, 420 for a moment, and you have fewer than 100 in the red. Take a look at what's leading. This is why we're higher right now. Apple, Nvidia, Broadcom, Amazon, AMD. Those are your biggest contributors on a points basis to this rally, dragging the S&P 500 higher by about 0.6%. Then take a look at the downside. You have Eli Lilly, no surprise there. It's down 13%, taking 9 points off the S&P 500. Fortinet, I know you've been following that one, Matt Miller. Maybe we'll mention that because it's down 25% right now. Airbnb also down, despite, as you said, Matt Miller, $6 billion in share buybacks. Markets typically like buybacks, but not in the case of Airbnb. There's a lot going on.